Let's start with the headline: development. PiBridge launched peer-to-peer lending functionality that fundamentally changes what PI holders can do with their tokens. Here's how it works. You can now use your PI holdings as collateral to borrow stablecoins, or you can lend your PI to other users and earn yields. PiBridge promoted this with the tagline, "Your PI doesn't have to sleep anymore," which is actually clever marketing because it addresses a core criticism that PI has been primarily speculative with limited utility. This lending platform represents infrastructure development that moves beyond simple trading. Collateralized lending creates economic activity and demonstrates that PI can function as productive capital, not just a speculation vehicle. If users can borrow against PI holdings without selling, it reduces selling pressure while providing liquidity. That's economically meaningful. But let's apply critical thinking here. Peer-to-peer lending platforms aren't revolutionary. They exist across crypto. The question isn't whether lending is possible, but whether there's sufficient demand and liquidity to make it sustainable. So, who's borrowing? What are the interest rates? What's the collateralization ratio? And what happens during liquidation cascades if PI's price drops significantly? PiBridge claims this marks the next step toward launching the PiBridge neobank. That's honestly pretty ambitious language. A neobank implies comprehensive financial services beyond just lending, payments, savings accounts, and potentially even credit products. If they execute on that vision, it could legitimize PI's utility proposition. But, execution is where most crypto projects actually fail. The critical metric to watch is, honestly, actual usage data. So, how many loans are being originated? What's the total value locked in the lending protocol? Are users earning sustainable yields, or is this just another yield farming scheme that, collapses when incentives dry up? We really need answers to these questions before declaring this a game changer. The second development is the PiApp Studio upgrade, which happened in mid-October with the goal of making decentralized application creation more accessible and customizable. PiApp Studio originally launched on June 28th, Pi 2 Day in community terminology, with the ambitious mission of enabling users to build dApps without programming. That's a compelling proposition because it democratizes development and honestly could accelerate ecosystem growth if the tools are genuinely user-friendly. The recent updates focused on accessibility and integration within the Pi ecosystem. So, while the specific technical details weren't really disclosed, the implication here is that non-technical users can now more easily create applications that leverage PI for all sorts of functions, like marketplaces, social platforms, productivity tools, or honestly whatever users can envision. Here's why this matters. Ecosystems thrive when developers build diverse applications that attract users. Ethereum, for example, succeeded partly because of its robust developer community creating DeFi protocols, NFT platforms, and infrastructure tools. If Pi can cultivate similar ecosystem activity, even if it's on a smaller scale, it really strengthens the utility argument. However, there's a massive gap between, enabling app creation and actually creating apps people use. So how many applications have been built using PiApp Studio? How many of those have meaningful user bases? What's the retention rate like? And are developers building sustainable businesses, or are they just experimenting with tools that don't generate real value? Pi Network also unveiled the Pi Hackathon 2025 in August, encouraging developers to build real-world applications expanding PI's utility. The hackathon was supposed to conclude October 14th, but Pi Network hasn't provided updates about its conclusion or winners. That communication gap is concerning because it suggests either lack of participation or organizational issues in executing announced initiative. Now, let's address the brutal reality of PI's price performance, because honestly, developments don't matter if the token is in free fall. PI currently trades around 20 cents after briefly dipping to 19 cents earlier. This represents a 26% decline over the past month and, here's the devastating number, a 93% collapse from its all-time high of $3 witnessed at the start of 2025. That's not a correction. That's value destruction on a catastrophic scale. Anyone who bought PI above $1 is sitting on losses exceeding 80%. The psychological damage to holder confidence is immense, and it creates skepticism around any positive developments because burned investors become cynical. The question every PI holder asks, is 20 cents the bottom, or is there more downside ahead? So, there are two technical signals that suggest a potential reversal. But, we really need to examine them critically, rather than just accepting them as guarantees. Okay, quick pause. If this objective analysis of PI's developments and technical setup is providing clarity beyond your typical Moonboy content, go ahead and hit that like button right now. It signals to YouTube that evidence-based crypto analysis actually deserves some visibility. And, hey, If you're not subscribed to TJ Crypto World yet, smash that subscribe button and turn on notifications. We're tracking PI's execution honestly here, acknowledging progress while, questioning sustainability. Alright, let's examine those reversal signals. The first potential reversal indicator is exchange outflows. Over 1 million PI tokens left centralized exchanges in just 24 hours, suggesting investors shifted towards self-custody methods. Exchange outflows typically signal accumulation rather than distribution. When tokens leave exchanges, they're being moved to private wallets, which suggests holders plan to keep them rather than sell. Conversely, exchange inflows often precede selling pressure as investors transfer tokens to platforms where they can liquidate positions. 1 million tokens in 24 hours is meaningful volume, particularly given PI's recent price weakness. It suggests that, despite brutal performance, some investors view current levels as accumulation opportunities rather than exit points. However, context matters. Exchange outflows can also reflect distrust of centralized platforms or preparation for staking or lending opportunities, like the PiBridge launch. Not all outflows represent bullish accumulation. Some might be strategic repositioning that doesn't necessarily indicate buying conviction. The question is whether this outflow trend continues. Single-day data points don't establish trends. If we see sustained outflows over coming weeks while price stabilizes or rises, it strengthens the accumulation thesis. If outflows reverse and tokens flood back onto exchanges, it signals renewed selling pressure. The second technical indicator is PI's relative strength index, currently hovering around 30. So, for those who might be unfamiliar, RSI measures the speed and magnitude of recent price changes to identify potential reversal points. Readings below 30, well, they indicate oversold conditions, meaning the asset has declined so aggressively that a bounce becomes statistically likely. Now, when readings rise above 70, they signal overbought conditions and potential correction. PI's RSI at 30 suggests that sellers have exhausted themselves temporarily, creating conditions for a relief rally. Historically, assets at oversold levels often experience short-term bounces as contrarian traders step in, bargain hunters accumulate, and shorts take profits. But, and this is critical, oversold doesn't mean the bottom is in. Assets can remain oversold for extended periods during strong downtrends. RSI below 30 signals potential bounce conditions, not guaranteed reversals. In severe bear markets, RSI can hover in oversold territory for weeks while prices continue grinding lower. For PI specifically, RSI has likely reached oversold levels multiple times during its 93% collapse. Each time, holders probably thought, this is finally the bottom, only to watch prices decline further. Technical indicators are tools, not crystal balls. So, what's my take on PI's current situation? Well, here's the honest assessment. PiBridge peer-to-peer lending and Pi App Studio upgrades represent genuine infrastructure development. These aren't just roadmap promises, they're live products that expand PI's utility beyond speculation. That's meaningful progress that, honestly, deserves acknowledgement. So, the technical signals, like exchange outflows and an oversold RSI, suggest there's potential for a relief bounce. But, potential doesn't always mean probability. PI could bounce to 30 to 35 cents on short-term momentum and still remain in, a pretty devastating downtrend. What concerns me is the massive overhang from holders down 80 to 93% who are just waiting for any rally to reduce their losses. Every bounce faces selling pressure from exhausted holders looking for exits. That creates resistance at every level between here and $1. For PI to sustain a meaningful recovery, it needs more than just technical bounces. It needs proven utility at scale. PiBridge lending needs significant adoption with, sustainable yields. Pi App Studio needs thriving applications with real users. The ecosystem needs economic activity that actually justifies valuations beyond pure speculation. Can that happen? Possibly. But it requires execution consistency over months, not just product launches followed by silence.